I think the only thing I'd add to that is if you look at the dividends versus the buybacks. So the numbers I looked at yesterday, and I think I have these right, is about 52%. The S&P, 52% of free cash flow went to share buybacks. The reason why that's so high, I think, is because executive compensation is tied to it. And my guess here is people rail against it so much because the harder thing to do would be to rail against the board of directors and say, hey, you shouldn't make the compensation, right? You shouldn't tie it to share price or earnings per share, et cetera. And so the incentives are off. Well, the only thing that the quote unquote public or those that aren't on the board can really rail against when it's an industry-wide thing is, oh, the share buyback's the problem. And so what I don't know is there another solution than just railing against the share buybacks where you actually go after the compensation structures? Because if you change the incentives, to your point, the share buyback and the dividend is completely the same thing, right?
So if you go check out all these FAQs on my blog post, it attacks almost every one of these myths. And there's much more in-depth academic people that have, Dalmadaran from NYU, Malvison, we mentioned, Cliff Asness, on and on and on, talk about each, in some cases, some of these myths one by one. And one of the studies, and I may get it precisely wrong, is that they looked at the EPS and companies doing buybacks and not, and it was no difference, right? The companies that were tying it to EPS weren't doing more buybacks than the one that weren't. That having been said, it's a stupid metric, right? Warren Buffett, most of these good CEOs, capital allocators, there's a great book called The Outsiders, could write down on a napkin in probably 5 minutes a compensation structure that made sense that's not tied to short-term stock price, but rather long-term performance of the company. And that's not that hard. I just think it's a boogeyman, a demonization that people like to latch onto. Like I mentioned, a very simple answer is, look, I don't care. But think about what happened. So like Elizabeth Warren and others came out and said, we're going to make buybacks illegal. And I say, okay, you know what you just did? You just said CEO has a lot more cash on his hands. What do you think he's going to do with it? He's going to go spend it. He's going to pay himself more. He's going to pay his execs more. He's going to go buy a jet. He's going to go acquire other companies and empire build, right? Like, so that's the last thing you want to be doing. So it's tough because, you know, there's a lot of things that people like to call attention to that just, it doesn't hold up in the data. And so I've kind of barred myself on Twitter. Sometimes I can't help myself, but almost every one of those myths, you can go down the list and say, no, that's actually not true. Or the data says this, the data says that. But again, it goes back to the CEO's only job is to maximize where he's using that cash. And so is it paying down debt? It could be. Is it new projects? Maybe. Is it buybacks or dividend? Like all these things, that's his job. And, you know, it's a topic that's emotionally charged right now because we're talking about bailouts, for example. And let's be clear, if the government steps in, and there's a long case study history of this, of the right way to do it, you bail out a company, whether it's an airline, a cruise ship, these stockholders should be zeroed, right? The CEOs, the executives that have executive compensation that's tied to shares, those shares should be worth zero. But that's the way it's always worked. That's bankruptcy, right? Company goes bankrupt. The U.S. could easily say, look, fine, we're going to backstop some of these airlines. That's fine. But your equity is now zero. Then it goes to bondholders, et cetera. The crony capitalism comes in where they say, no, we're going to protect the shareholders. That's the whole point of being an equity shareholder. You accept that risk, right? Stocks go to zero all the time. Like we mentioned earlier, the distribution is like a third of them go to zero. And so people like Mark Cuban, love him, God bless him, but he's like, if we bail out some of these companies, they should never be allowed to buy back stock again. And I'm like, it doesn't make any sense. They should not be allowed to pay dividends. What do they do with the cash? And by the way, if you get to be a fat, bloated company, those dividends and buybacks, guess what happens with them? They get recycled back into the young, emerging growth companies that are employing and hiring lots of people versus these big, fat, bloated ones. So anyway, it's look, man, it's a topic that just I think is emotional and is something that people want to latch onto. But I don't think there's any there. Little things you could change on the edges, but for the most part. And by the way, we haven't mentioned this on the investment side. the number one thing you want to be attracted to is companies that are high quality, trading at cheap valuations. And Buffett says this, the best thing a company can do with its cash, if it's trading below intrinsic value, and I'm a quant, so you come up with quant value metrics, is buy back their own shares, because you're buying back something for 80, 60 cents that's trading for $1. So you can take this all the way back to the 1920s. We call it shareholder yield, but it's combining dividends and net buybacks, so net of issuance, combining the two together, and figuring out dividends are the most nonsensical investing strategy on the planet. They're tax inefficient, and it's kind of a crappy way to do value investing. It's not a real value tilt. They tend to be leveraged companies, kind of junky. You do the shareholder yield, you add a value filter, it stomped almost all dividend investing approaches all the way back to the 20s and in most decades. So there's from the allocator standpoint as well as the, but what you want at the end of the day is a good business CEO who's thoughtful, who's thinking about all the ways to maximize return, and do so in a way, by the way, the problem we're seeing this year is where it's anti-fragile, right? Where a short-term disruption is not going to zero the company, because those things happen.
Yeah, I think that we actually see eye to eye on a lot of this in terms of the share buyback isn't the quote unquote evil thing, right? To me, it's the bailouts and really the structure of how the bailouts happen. And the other piece of it too is you specifically said, look, the risk you take as the equity holder is that it can go to zero, right? You can get zeroed out there. And again, I think that there's a balance between, hey, we had a really great business. There was this black swan event and we didn't do anything wrong, but this occurred, versus I think when people look at stuff and say, hey, you had, 80% of your free cash flow you spent over the last 5 years doing the share buybacks. Well, if you had held that, you could weather this. Then I think the question really comes down to, what's the right answer? Unfortunately, regardless of how much people want to debate, I don't think there is a right answer. That's why there's the debate, right? Is because many different people have different perspectives of it. But I think you articulated kind of what that trade-off there is.
I would love for politicians to make dividends tax-free. They won't, because it generates revenue for the government. The same way, look, by the way, there's nothing more predatory that every state has and the government has than lottery system. That generates tons of revenue. But if you're to ask a lawmaker, by the way, you're preying on uneducated, poor people. Why are you doing this? And there's plenty of other systems in the world that have savings-based lotteries that actually help people save, but they're addicted to the revenue, right? So it's the same thing with dividends versus buybacks. Like a simple solution overnight, just make dividends tax-free.